In this video, we will see the 3 mistakes keeping you from high returns, and we will see how you can avoid them. My name is Christophe Nour. I've been investing in the stock market for almost a decade with a performance of 25% per year. And when I started investing, I did these mistakes. I made these mistakes. So let's not waste more time. The first mistake to avoid is to invest in hype, in sectors that are out of your circle of competence. The markets can be very irrational. The markets can have some ups and downs, and some industries may be hot. Some industries, I'm thinking of AI right now. Some industries go up and to the right. Some companies, the stocks, they go up and up and up and up. And you are here with your portfolio of safe stocks that could be anything. Something safe, alcohol brands, cigarette stuff, European banks. We are talking about safe companies, and they are going down. So you are there is a mismatch in the market. Some industries are sexy. Some industries only go up. The stocks only go up. And in this moment, you will feel envy. In this moment, you will feel greedy, and you will see your neighbor getting richer. Your dumb neighbor is getting richer than you because he put all his savings into Nvidia and Bitcoin and Dogecoin, and that could do the work. And I mean, these investments can be legit or not. I know personally these are not in my circle of competence, so I would not touch them. But if you are an envious, greedy, you may be a victim of envy and buy these sexy hot stocks. We are talking about hot tips. We are not talking about a clear analysis of a business. Sometimes, and I see this a lot on Twitter, on X, people say, oh, you know what, let me sell some of my safe stocks and buy Nvidia because of FOMO, big FOMO, fear of missing out. You invest just because of hype, and you invest out of your circle of competence. I've seen plenty of people making this mistake, investing in companies that they don't really understand, investing in companies in sectors that they don't really understand. They don't know the opportunities of this company. They don't know the threats for this company. And after 1 year, 2 years, 3 years, they get washed out. Yeah, they lose a lot of money. That's how you can make a stupid mistake of investing in a company that you don't really understand. My recommendation is always to invest in companies that are inside your circle of competence. If you are a software developer, you know more about the software industry than most people. Stay in your circle of competence, being a tech guy, software developer. If you have been playing the golf for 20 years, you know more about the golfing industry than most people. This is your circle of competence. Personally, I've been a video game player for 15 years. I know the video game industry very well. This is my circle of competence. I'm a young French guy that played a lot of games when he was young, and I still play video games. I know them very well. There are successful companies that are in the video game industry. You know what? I know them better than most people. Even most young people, I know the video game industry very well, and I will not invest in some other companies, for example, that are out of my circle of competence. My circle of competence is small, but the most important part is stay within and know the boundaries of your circle of competence. Your circle of competence can be really small, really tiny. Maybe you have had a life with golf, software developer, and a vacation to the ski. So skiing. You know these 3 industries. There are companies, profitable companies, winning companies in these 3 industries. You just have to find them, analyze them, and you will know more about this industry than most people. So it will be quite easy to do the research. My recommendation to fix this FOMO is to have a clear discipline, a clear framework. You can write it out on paper, on your phone, etc. Stay within your circle of competence, basically. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Second point, assuming high growth for uncertain businesses in the DCF. Oh, you saw my third point, so okay. Anyway, let's put my third point is. The second mistake I see a lot is when you analyze a company that has grown recently, like EPS growth has accelerated 20% growth. people tend to extrapolate. There is a, how do you say it, recency bias. People think that the most recent events in the past 1 year, 2 years will continue, so they extrapolate the results. And when you do a DCF, discounted cash flow model, to value a stock, they think that the growth rate will be up 20% per year for the next 20 years. There is a study from Credit Suisse saying that no business can grow 20% per year for decades. The only exception they highlight is Google, if my memory is correct, and that's it. Most of the time, competitive capitalism works in this way. You grow fast, small startup players come and eat your lunch, so you grow a little less fast, a little slower, and then competition comes again, and all your competitive advantage fades out, and this is the way capitalism works. You have the destruction creation process, and this is part of human life. I mean, we are as human, we have the same phenomenon. We live and we die. We live and we die. This is the same phenomenon, and we improve over decades and decades. Capitalism and the economy is working the same way. So don't extrapolate extremely good results. If a company has grown 1, 2, 3 years, like 20% per year, don't think that they will continue to grow 20% per year, because this will drastically change your valuation in your DCF model. So it will drastically change your intrinsic value of the business model. If you put your high growth assumption for the next 5 years, you will say, oh yeah, the stock is cheap because look at the growth in the future. But if you are taking a more conservative approach, maybe the stock is not cheap at all. So my advice for you is be conservative in the numbers. Don't think that they will grow forever. Trees don't grow to the sky. Be conservative in the numbers. Maybe play it safe. Maybe a little bit too safe. That can't hurt you. Invest with a margin of safety. That's really important. You don't want to pay a very high price for a business. That's how you can make a stupid mistake. And the third mistake is trying to time the market. And I know what you're going to say. No, I never try to time the market, but everybody has some cash here and there from their salary, and they say, no, I will wait for a correction. I will wait until the market crashes 20% and then I'm in. I've seen this phenomenon, and the most recent one was 2022. The market crashed 15-20%, and the same people that had the cash said, oh, the market is down 20%, it will drop more, 30%. At 30%, I'm buying. You know what? The market doesn't care if you lose 20-30%. The market rebounded sharply. It went down 20% and then back up. And then you have 2023 up, 2024 up, and they lost a lot of money. You have a huge opportunity cost trying to time the market. And actually, yesterday, I listened to an interview of one of our French best investors, William Higgins, and he said, we never have some cash because this is a huge drag on performance, and we never try to time the market. And William Higgins has been doing, 14% per year for the past 20 years, 30 years. So we are talking about the top 1% investors. And he said, even if you are very good at it, it's not worth it. It's stressful, and this is not your goal as an investor. The goal is not to try to time the market. The goal is to make money with profitable companies. So if you take a long-term horizon, just invest in good stuff, in good stocks. Over time, they will go up because these businesses will increase in value, more revenue, more earnings. If you buy them at a fair value, cheap price, they will go up. Trying the market is a waste of energy, a waste of time, a waste of efforts, of valuable resources that could be used to research other stocks. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.